Hello, everybody, and welcome to today's Lunch and Learn series. My name is Steve Mahoney. I'm here with Kathleen Thompson. We're from the Greater Hartford chapter of SCORE. And today is the third in our series on getting yourself organized for the new year. Today's topic is getting your financial house in order. You can see the topics that we have in our series. If you missed the previous two classes, you can check them out on our YouTube page. Just search for Greater Hartford SCORE. So with that, we're going to jump into today's topic. Now, I want to start with why we're here. And I don't mean this in the existential sense. That is kind of a different workshop. But why we're here in terms of getting yourself organized for financially for the start of the new year. And as people think about their financial records, a lot of times people think about record keeping for tax purposes. And they think about getting themselves organized for financially, it's all about taxes. But it's also important to understand what's going on in your business financially, to understand the trends in your business and the trends in the market. So there's a lot of aspects to getting yourself organized financially. I also like to tell my clients that I work with that the past informs the future. Understanding and using your past financial results can help you make better business decisions in the future. So we're going to talk today about how to look at your financial results from the most recent year and what things to look for and how to help that inform your decisions in the future. We're also going to talk a little bit tax preparation since it's that time of year. And the other thing that doing this kind of work can do financially is it can help you answer some key questions. Can I make more money? And if so, how? Is my product or service priced right? And then what might my business look like in the next few years? So we're going to start with a little acronym that I came up with, which is CAP, C-A-P. And the first is collecting your records. That's the first thing you're going to do. The second is you're going to analyze your financial results. And the last is you're going to prepare for your future. So we're going to go through each one of these little steps. And the first is to think through collecting your records. So what does that mean? So we're going to talk financials here. So we want to make sure that our financial records are up to date with our most current month, most current results. I'm assuming a lot of you are using QuickBooks or some other financial software. The first thing you want to make sure you do is that all of your records for your revenues and expenses and all your cash transactions and any inventory you've purchased, anything like that, have all been recorded in QuickBooks through December of 2023 at least. We're in the middle of January now, so it's good to have through the end of the year updated in your records. And you're going to want to do this on a timely basis. Most of you probably are. The other important step to do is to make sure that you're reconciling the cash account in your QuickBooks to the cash account in your bank account. That's on your online bank statement. So that's something you're going to want to keep an eye on week to week. So once you've ensured that all your financial records are up to date in QuickBooks, you're going to run three key reports. You're going to run your balance sheet as of December 31st, 2023. The balance sheet is a snapshot point in time view of your business. It's an as of date. It means as of the end of the month. In this instance, we're going to run it at the end of December 31st. You're also going to run your income statement and cash flow statement for the year ended 12/31/2023. Those two statements cover a period of time. When you run your income statement for the year, it covers all your revenues and expenses from January 1st through December 31st for that calendar year. So those are the key pieces of information. We're going to show you some examples of some financial statements and what to look for in a minute. Now, you may be asking yourself, oh my God, what if my records are outdated? Is it hopeless? I haven't updated my QuickBooks. My QuickBooks is a mess. I don't know what to do. The answer is just stop, hang on, get some help. I've had clients who've had this in the past where they've had different instances of QuickBooks or their QuickBooks are outdated. My recommendation is work with QuickBooks on their help desk if they offer some help for you, or you can contact a local bookkeeper to help you get your financial records up to speed. The most important thing is to get your balance sheet correct as of 12/31/2023. What that means is that you get your snapshot point in time of your cash, your inventory, receivables, payables, debt. Get that adjusted and corrected as of 12/31/2023. And what that'll allow you to do is going forward, you're going to be in a good starting position so that month to month, your financial statements will be okay. So analyze your financial results. That's the second step after you've collected your records. So what I've got up here on the page here is just an example balance sheet, right? It's just a pretend company, but I wanted to walk you through what to look for in your balance sheet and kind of what some of these terms mean if you're not familiar with them. So the first thing you'll notice is assets are on the left-hand side, liabilities and equity are on the right-hand side. This is a very typical presentation of a balance sheet. You'll also notice that in the title of it, balance sheet, it is balanced, meaning the total assets equal the sum of your total liabilities and equity. The other thing you'll notice is that a lot of times a company's balance sheet will be organized into what's called current assets and long-term assets, and current liabilities and long-term liabilities. So what does that mean? Usually what that means is current by an accounting definition usually means 1 year or less. So in the liabilities section, it's pretty easy to figure this out because you'd say to yourself, this business has $47,000 of current liabilities. It's expected that these liabilities are all going to be paid off within a year. And that makes sense. Accounts payable, notes payable is probably the current portion of their debt. And some of these other items will largely mature over the course of the next 12 months. And you can see this business also has $200,000 of long-term debt. That's going to be the period of time beyond 1 year. On the asset side, current assets, this is typically how a balance sheet will be presented. And it's specifically starting with the most liquid asset to the least liquid asset is kind of the order that a balance sheet gets presented. Cash is always the first item because it's the most liquid asset. Then you go to receivables, which are going to turn into cash pretty quickly when you collect the cash. Inventory, which is going to turn into cash when you sell your inventory. Then they've got some investments. And then down here, you can see they've got what are called long-term assets, which is your land and your building and things like that. So as I'm thinking about a balance sheet, when you're looking at this balance sheet, it's as of a certain date. So this is the snapshot as of December 31st. One of the questions you're going to ask yourself is how do I feel about my cash balance? Cash is really critical for a small business. It's all about liquidity and understanding how much cash you're going to need for the rest of the year. You've got cash on hand now. You're going to be collecting and spending money over the next 12 months, but your starting cash balance is going to be really important for you to understand your liquidity needs for the rest of the year. The other thing you want to look at are what's called current assets versus current liabilities. A lot of banks will look at this to understand the answer to this next question, are you over leveraged? So when I look at this business and I say they've got $149,000 of current assets and $47,000 of current liabilities, that makes me feel pretty good because their current assets are higher than their current liabilities by a decent amount. They've got a good chunk of their current assets are sitting in cash, which is a nice liquid asset, and they can probably handle paying their current liabilities pretty quickly. Now, when I look at am I over leveraged, this business does have $200,000 of long-term debt. They also have a pretty substantial amount of long-term assets. Now, the reason this is important is because if a bank is evaluating you from a lending standpoint, they're going to want to know how liquid you are. Now, if you had very little cash, very high current liabilities, and a lot of long-term assets, the bank might be a little worried if you'd be able to pay back your debt. The reason is it's very easy to turn accounts receivable into cash because you can collect it from your customers. It's very hard to turn buildings and improvements in land into cash because it may take you longer to sell them. So understanding your current assets versus your current liabilities, and then the relative nature of your long-term assets and long-term liabilities. This business does have $200,000 of debt, which is probably a mortgage related to buying a lot of these long-term assets. So as I look at this business, I'd say, okay, that feels pretty good. It doesn't feel like they're over leveraged. I'd want to understand their business plan. Then you also want to ask yourself if your assets are high quality. What does that mean? Well, how do you feel about the nature of this receivables? Are they current? Are they from customer sales that have happened in the last 60 to 90 days? Or are they really old and you may never collect them? If it's the latter, then that might be a bad asset that you're going to have to write off. And that could be problematic because you're not going to turn that receivable into cash. Same thing with your inventory. Businesses are looking at inventory if if it's food and it gets spoiled and it goes out of expiration date and they have to throw it away, or if it becomes obsolete and a customer is not buying it anymore, that inventory, again, may not turn into cash. So thinking about if your assets are high quality or not is important. In terms of your long-term assets, you want to understand the valuation that you've got. In this instance, they probably took out a mortgage. They probably got an appraisal for the land and the building. So they're probably okay, but that's something else to consider. The last one is looking if your total equity is positive or negative. Well, how could this happen? Well, if you were losing a lot of money or taking a lot of money out of your business, your equity could go negative. And now, when I look at this business, they've got 472,000 of assets, liabilities of 247, and then their equity is about $225,000 or so. So that's pretty good. It's positive equity. It's a good ratio. I feel pretty good about that approach. If the liabilities were really high and the equity was actually negative, that would cause me concern to say, wow, can this business afford to pay off all their debt? Have they been losing a lot of money, which would cause their equity to go negative? Or have they been taking a lot of money out of the business when they really couldn't afford it? So that's something to keep in mind. The next step in assessing your financial results is analyzing your income statement. So I've just given an example of an income statement here. Now, this may look a little bit different depending upon what kind of business you have, but this is a typical income statement just for a single year. It's got revenue and cost of goods sold, which is your gross profit. This concept is really applicable for manufacturing and retail companies, the concept of cost of goods sold and gross profit. If a services company would not really have cost of goods sold because you're really selling your service, selling your time. So you'd probably just have revenue. So that would be the big difference in an income statement. I know we've got some service folks and some retail e-commerce folks on the call today. So one of the things you're going to want to look at is your revenue growing or shrinking? So this is just 1 year, but if your QuickBooks can run you multiple years of an income statement, you can see, is my revenue going higher or lower year over year? Ideally, you want that to be growing. Gross profit. This answers the question, is my product priced correctly? Because when you're in the retail and manufacturing world, your gross profit, which is revenue minus cost of goods sold, that is going to help cover your operating expenses and generate whatever is left over for operating income to pay your interest, pay your taxes, and then your bottom line profit is going to pay yourself. So your gross profit is going to be key, because if this turns upside down on you or gets really narrow, really thin, meaning you've got a thin profit margin, that can help, or that's going to hurt you in the sense of you're going to have less to cover your operating expenses, your interest, your taxes, and paying yourself. We talked about product and retail versus service companies, operating expenses. This is basically answers the question, are you efficient in how you run your business? Gross profit is more a function of what you're selling and how it's priced. Operating expenses means how am I running my business efficiently or not efficiently? And one of the things that you want to look at is where you're spending money on. And if you've got fixed versus variable costs, it's important to make sure your fixed costs are staying fixed and they're not growing. Things like rent, which sometimes increases, but hopefully you can keep your rent fixed. Some of your other overhead costs like legal or accounting fees, hopefully you can keep those fixed year to year. Your variable costs, the ones that are tied to your revenue, are the ones that should be growing at the same rate at your revenue, or hopefully less than your revenue is growing, so you can increase your profitability. So the operating expense is looking at where you're spending money and how you're efficient or not in running your business is a key aspect. Now, the other thing you could look at is if you did a budget last year for some of these financial statement line items, you can compare your income statement against your budget and see where was I higher or lower and help understand the drivers of that. So that's step 2 of analyzing your financial results. The third is the cash flow statement. Now, what I've depicted here is just a sample cash flow statement that will be a typical one that you'd run out of QuickBooks. You'll hear sometimes the phrase cash is king. The income statement is very important, but the cash flow statement tells a deeper story for each business. And the reason is that it covers some things that are not included in an income statement. So as you're looking at your cash flow statement, I'm going to walk you through how this is organized. It's really in 3 main sections. The first is operating activities. The second is investing. The third is financing. The total gives you your total cash inflow or outflow. And then the bottom line just says, what did my cash do over the course of the year from beginning to end? Now, operating activities is very similar to your income statement. It's a little bit different. You can see the cash flow statement starts with net income, and they have this section where they adjust net income to net cash from operating activities. This would be things primarily like if you've got depreciation on a building, they add that back because it's a non-cash expense in your income statement. If you have changes in your receivables or payables, those impact your cash differently than how they impact your income statement. But your QuickBooks report is going to give you this information and show you, here's what my cash provided by operating activities was. It's not the same as net income, but it's pretty close in terms of concept. It's pretty much the fundamental operating results of your business in terms of how it's performing. Investing activities answers the question, what did you invest with in your operating cash flow? So if you buy a building, buy a piece of property, buy a vehicle, invest in some machinery, That's where your investing activities are going to go. And you can see that's primarily here. They've got capital expenditures of $48,000. Financing activities, there's a few things in here. One would be any activity that you are interacting with your bank on, whether you borrow financing money or you pay it back, anything that you've previously financed. You can see that here. They've got proceeds from a business loan of $150,000, payments on current debt of $52,000. So this is where your financing activities are going to show up. The other place that this will show is any money you pay to yourself through an owner's draw. So you can see here it's labeled as a cash dividends paid. This means dividends to the owners. An owner's draw is the same concept. Now, what's really important about the cash flow statement is this last concept here. Investing and financing activities don't always show up on the income statement. And that's primarily for capital expenditures, owner's draw, and loan activity, because those are really cash-only transactions. There's some expenses associated with them, but when you pay yourself an owner's draw, it's not going to show up on your income statement because it's not an expense of the business. It's a cash transaction that reduces your equity. It impacts your balance sheet, but not your income statement. So the income statement's an important financial statement to look at, but so is your cash flow statement. So as you're thinking about this, assessing your financial results at the beginning of the year, you want to look at both to try to understand them. So I'm going to give you an example that I've used in a class before that you may have seen before, but this is just a comparison of a few different cash flow statements. So this is organized very similarly. You got the operating activities, the investing activities, and the financing activities. And I'm going to give you 3 different scenarios. The first is what I'm calling the dog ate my profit. So what does that mean? Well, in this business right here, they had revenue of $60,000. They bought some inventory and they made some operating expense and payments, and they had $28,000 of, call it, profit. That would be pretty close to what shows up on their income statement. They also paid some interest. They also paid some taxes, and they had $24,300 of cash from operating activities. Pretty good. But when they get down to their balance on their cash on the balance sheet, it's only $6,300. And they're like, well, what happened to my profit? I know I made money because my income statement says I did. Well, they bought some new equipment of $13,000. They also had to pay some debt back for $7,000. So when it came down to it from a cash standpoint, their cash only went up $4,000. So this is where it's important to look at your cash flow statement and your income statement to understand where some of these differences may apply, because this purchase of new equipment and your debt payment is not going to show up on your income statement. The second is what I'm calling the bank balance mirage. So this is one where the company looks and says, well, my cash, it's about $6,500 at the end of the year. It was $5,000 at the beginning of the year, and it's up at $1,500. So I'm doing okay. But if you peel apart what's going on underneath, you can see that from a P&L or operating standpoint, they actually lost cash. They only had $35,000 of revenue, but they bought a lot of inventory. They had a lot of operating expense payments. They had to pay some interest. They had to pay some taxes. Cash flow from operating activities was down $21,500. They also bought $12,000 of new equipment. Like, where did they get that money from? Well, look at the financing activities. They borrowed a lot of money from their bank. They borrowed $33,000 from their lender. Now they paid some of it back, and they also had to put $8,000 of their own money in. So their financing activities of $35,000 of cash coming into the business helped mask these investments and this cash flow problem from operations. So that's why I'm calling it the bank balance mirage, because their cash is flat-ish year over year, but they borrowed a lot of money, and now they've got a lot of debt on the balance sheet. The last example is what I'm calling the balanced business. Now, this is easier said than done. This may be a little bit of a rosy picture, but this is kind of a balanced standpoint where you can see that the business is doing well from an operating standpoint. They brought in almost $36,000 of cash from operating activities. They did a little bit of an investment to buy some new equipment. They borrowed a little money. They paid it back from their lender, and they also paid themselves $12,000, and their cash actually went up during the year. So that's kind of a nice story, right? They made some money, they put a little bit back into the business, they paid themselves a little bit money, and they left some nice cushion on the balance sheet at the end of the year. So what I'm trying to get at here is that the underlying results that are going on with your business may be masked by some of the ins and outs, and it's important to understand all categories of your cash flow, because understanding all of these pieces can help you plan and avoid some surprises down the road. So we've collected all our records. We've analyzed our financial results. What do we do now? Now we're going to plan. What do we want to do? Well, the first is you want to think about if you need to create or update a budget. Did a budget last year. You can compare it to how you did. Maybe you want to do a budget for 2024. Maybe you feel like you're in a pretty good financial standpoint and you don't really need to do a budget, but you maybe want to plan for a few things here and there. That's fine. A budget really can help provide a roadmap for you and help you track how you're doing along the way. I advise people to try to do a budget once a year and then look at it every couple months to see how they're doing. If you're feeling cash is very tight, you may need to look at it more frequently, and quickly try to change things if you feel like cash is going to be tight. The nice thing about a budget is it shows you the art of the possible. You can do a couple different business assumptions around revenue volume or different spend levels on a marketing campaign, let's say, or when and how you can pay yourself depending upon the profitability of your business. So the art of the possible can be shown based on different business assumptions, and you can do a couple different scenarios. The other nice thing about a budget is that it helps identify what I call the big bets and risks to your financial goals. So as you think about stepping back and looking at your budget, you say, okay, this all looks good. I feel like I can make a decent amount of money here, but what are the things I got to make sure I just nail perfectly? Sales is an obvious one, but maybe you got to be, discretionary about how and when you spend a certain amount of money until some risks are averted. So helping to identify the big bets is important. The budget can also provide some insights into fluctuations in revenue and expenses as the year goes on. So as you're sitting here 3 or 6 months into the year and you think, gosh, I thought I'd be doing better than this. If you did a budget at the beginning of the year, you can help understand where and how you're better or worse. It also can help you help make you think through better business decisions. One of the things that's nice about doing a budget is you have some clarity into what you think the next 3, 6, 9, 12 months are going to be. And then you can decide, well, I feel pretty good about my revenue for the next 6 months. I'm going to go ahead and make that investment now because I can afford it. And then you can use the results of the analysis that we just talked about and looking at your different financial statements to inform what I would call the budgeting parameters. How deep of a budget do you need to do? Maybe it's a high level, maybe it's a more detailed one. Now, the next page shows this is a tool that I've used with some of my clients, and I've taught a class on this before, so you may have seen this before. This is a cash flow budget template. You'll get a copy of this emailed to you in the materials that you'll get tomorrow. But this just kind of shows how you can plan for your cash flow over the course of a 12-month period. I've shown the first 6 months here, but it's somewhat straightforward. I know there's a lot of rows here, but the gist is you think through your cash at the beginning of the month and you plan for your sales, your cost of goods sold, your fixed expenses, your variable expenses, and then also some of those investing and financing activities that we talked about. Things like your bank activity, things about your capital investments, and any capital contributions or owner's draw that you're going to do yourself. Doing an exercise like this can help you think through what some options might be for the year. Now, some of the line items in here might need a little bit more detail behind them. So for instance, as you're thinking through your sales budget, you're going to probably want to have some sort of revenue spreadsheet that helps you calculate how many clients am I going to see this year? What is my average rate that I'm going to charge them? Or how many units of my product am I going to sell this year? And, what's my pricing model going to be? So some advice as you're thinking about doing a budget, determine the business drivers for the major line items. So what I mean by that is, revenue is somewhat obvious. It's going to be your the number of units or the pricing that you're going to have or the number of customers you're going to have. But as you're thinking through your expenses, try to understand if there's a driver for each expense. Your variable ones may be tied to revenue. Your fixed expenses hopefully are tied to a lease or an agreement you have with your accountant or your lawyer. And your payroll can be dependent upon your hiring plan, how many people you're going to have and what rate you're going to pay them. So those are examples of business drivers that will help you plan for each of those line items. I recommend people do it by month, especially when they're starting out. New startup businesses are like living on the edge when it comes to cash a lot of times. I don't want you to spend all of your time budgeting, but having some sort of estimate so you know what the guardrails are for your financial outcomes can help you think through those decisions that come up that says, do I want to spend money here or not? Or what should I be spending money on? It can really help you manage your liquidity and help you think through initial capital if you're just starting out before your operations have started. I recommend using what I call the 80-20 rule, or what's commonly referred to as the 80-20 rule. Focus 80% of your attention on the 20% of the items that are going to actually move the needle. Sales, variable costs are going to be the biggest items that require the most judgment. Thinking about spending your time and energy there to try to capture those. Your low important items, it's important you capture them, like your insurance or internet costs, but it's going to be a pretty tight range of what the estimate's going to be. So pick a number, put it in the spreadsheet, and go from there. Um, I also recommend you document your key assumptions and consider different scenarios. So one of the tricky things that happens when people are going through this is they say, well, I thought I was going to do $10,000 of revenue per month. When you get to, June, and you're not quite sure why you're not getting 10,000 a month, it's helpful to go back and say, why did I think I was going to get 10,000 a month? Which of my different service packages was I going to offer? Which of my different products was I going to assume, and at what price? So having some sort of support for your assumptions, that can help you determine when you get down the road, where did you exceed or fall down in terms of your gap to your budget. Number four is don't let perfect be the enemy of good. I have a wise guy saying when I talk to people about budgeting, which is the only thing we know about a budget is that it's wrong. And that's because it's an estimate. And when you're doing this, when you start putting numbers in the spreadsheet, it becomes it feels like it's real because it's in black and white. But always remember that this is an estimate. Your goal is to try to find the guardrails of what if scenarios that could happen with your business over the course of the year. And then most importantly, you can use this budget to help inform business decisions for the year. Thinking about where your cash may be highest or lowest, where the weak points in your sales forecast, where you might need to tighten your belt on your spending, and when you can pay yourself, when you know you're past a certain hurdle to be able to pay yourself. So hopefully this is a tool that you could find useful. Again, you'll get a link to it, an Excel file in tomorrow's email with the information about this. All right, talk a little bit about taxes. I do have to give a disclaimer. I'm not a tax accountant. I'm not a licensed CPA, and this is meant to be general guidance, not professional tax advice. I highly recommend you consult with a CPA to both prepare your tax returns and help you with tax planning. So this is a typical time of year when people start thinking about taxes because it's the beginning of the year and we got to think about our taxes from the previous year. The annual filing process is coming up. A lot of people either file in April or maybe they do an extension to October. If you do an extension, you still need to pay an estimate of what you're going to owe for your 2023 taxes now. Your payment is required in April. The IRS likes to say you're extending your filing of your return. You're not extending the payment of taxes you owe. It's also important to remember quarterly estimated payments. And there's different dates throughout the year that you're required to make estimated tax payments. If you were doing this full time, and I know a number of you are, this is your only source of income. If you don't make estimated tax payments throughout the year and you wait until April of the following year and you have a pretty big tax bill, not only is it going to be a big tax check you got to write, but you're also going to be likely, the IRS and the state are going to probably assess you penalties and interest. And that's because you're required to estimate your taxes and pay them as you go throughout the year. So you make a quarterly estimated payment in January, in April, et cetera, et cetera. And what this basically does is this lets you put kind of a down payment towards your tax bill. And then when you get to April of the following year, you settle up how much you owe for the year minus what you've already made in estimated tax payments. If this is your only source of income and you're not doing that, I highly recommend you work with a CPA to think through a tax planning strategy to do that, to minimize your surprises and minimize any penalties or interest you have to pay. You're also required to pay Medicare and Social Security taxes. Again, work with your accountant on calculating that and including that with your estimated payments. If you have employees, you need to do income tax withholding for federal and state. Also need to handle Medicare, Social Security, and unemployment tax. That is a requirement. If you were using a payroll company, they will typically do this for you. Sales tax. This is a very common one for probably a lot of you. Some businesses it's required. Some businesses it's not required at all. My advice, research your business requirements on the state of Connecticut website. There's a link here. I'm also going to provide you a link in the document you'll get tomorrow. The state of Connecticut's tax section has some really good information. So I highly recommend you check that out. And as it goes with sales tax, you're required to collect the sales tax from the customer and remit it to the state with the form stipulating this is what my sales were, this is what my sales tax was, this is what I collected, and here's, my payment back to the state. That's your responsibility as the business owner to remit that. I gave a couple examples here at the end that you might also have to deal with, which, I'm calling them local taxes, but whether they're permits or licenses, or if you're doing business in terms of a DBA, you may have a renewal there. This is the time of year to kind of think through those things and say, oh yeah, I've got my license. When does that renew again? I've got my permit for my building. When does that renew again? Let me make sure I get that on my list for this year. So we're in tax preparation mode because it's the beginning of the year and we have tax filings coming up. But I like to remind people that this is the time of year when you should be planning everything you want to be doing for the entirety of the year, because tax planning is not just an annual exercise. You've got quarterly estimated payments. You may have monthly sales tax returns to do, and you may have biweekly payroll tax, filings you need to do, or withholdings you need to do. And some of your permits and licenses and other things may renew in April, July, October, whatever. Now is the time to gather all that stuff together and say, okay, let me make sure I've got everything itemized out and I know what I've got to cover the rest of 2024 by month. Other topics to think through that are in kind of the finance world as we're starting the new year. The first is pricing. I didn't want to go too deep on this today because it's probably worth a separate class, but one of the things you can do is use that financial statement analysis to inform, any needed changes you have for your pricing model. I recommend people look at their pricing at least annually, more frequently if needed. This is very hard, obviously, because you got this concept of pricing elasticity, which is basically a function of a business wants to charge as much as they can, but at some point a customer is going to pull away and be no longer willing to pay that price. And that tension is called pricing elasticity, which is where can that healthy, tension meet in the middle, where the business is charging what they need to earn a sufficient profit, yet they haven't driven their customers to a lower price product or a different product in the market. So that's very tough to figure out, right? Shopping the competition, the external factors, are their products and services similar enough to you? What's their pricing strategy? What's their distribution strategy? Do they have the same kind of marketing campaigns that you do? And then in terms of the pricing, the internal factors is how much do you need to price your product for? How much do you need to charge your customers to earn a sufficient living? And do you need to course correct some of your pricing to maybe shift to products or services that are higher margin, where you're going to make more of that gross profit, and maybe say, I'm making more per unit on this product A versus product B. Maybe I should shift my marketing campaign to something for product A because I'm making $12 a unit, whereas product B, I'm only making $4 a unit. So that can be another kind of internal analysis that you could do. So looking through your income statement, your cash flow, those kind of activities, and really understanding what's going on with your revenue and cost of goods sold is a good way to think through if your pricing model needs to be updated. Now, when it comes to services, this is trickier because you're not selling a product, you're selling your time, selling your service and expertise. I know sometimes clients will say they may look at their service on an hourly basis. They may say, well, I have capacity to serve 10 clients over the course of a month. And if I charge them $3,000, a service, I'm going to make, $30,000 in services revenue this month, or, a similar type of example. So you can think about it on an hourly rate. You can think about it in terms of how much capacity do you have over the course of a month to service certain clients. You may have different package offerings depending upon the business you're in, and you may charge. Maybe you've got a service offering that is product package, A, B, and C, and maybe you've got different service revenue pricing for each one of those. So there's different ways to look at this if you're in the services business. Again, I don't want to go too deep on that one today because it would probably be worth its own class. Just other things to think about putting on your list for the year, since we're at the beginning of the year. Connecting with your bank. When's the last time you connected with your loan officer? If you've got debt, you're probably making your loan monthly payments. You may be sending them required financial statements or any other information, but just even connecting to them to let them know what's going on with your business, especially if you are thinking about expanding into a new product, a new location, working with them to make sure they understand what's going on. Probably not a bad idea to just set up a meeting with them just to do a check-in. insurance policy renewal. Now, you will likely get, if you've got a business insurance policy, and if you don't, I recommend you get one. It is highly important for every business. You're probably just going to get a renewal in the mail that says your business policy, insurance policy is up for renewal. Here's the new premium. Your payment is due by whatever date. But it's probably worth looking at your insurance policy to see if anything changed with your business in the last year. Maybe you got into a new service. Maybe you start to feel like you are at more risk for cyber hacks and you want to get some cybersecurity coverage. Maybe you are thinking about getting a new location and you need to tell your insurance agent about it. So, looking at your insurance policy and trying to understand what may have changed in the last year is also important. Same thing with your lease. If you've got, if there's space that you're renting with your landlord, trying to understand if there's been any changes in your business that you need to consider as your lease renews. Somewhat related to the finance topic is doing an updated risk assessment. Now we've talked about SWOT analysis in the past. The one of the videos that I'll reference when we get to the resources is we did one on risk management and thinking through assessing the risks for your businesses. Probably a good thing to do this time of year, as you're thinking about planning for the next 11 months, taking a fresh look at your risk assessment and seeing if there's anything you want to address this year, because maybe that risk is getting a little bit too high for your comfort level and you want to try to do something about it. So thinking through that. Then the last one I've got in here is looking at your credit reports. This is something you should be doing at least once a year. The 3 credit agencies, you can get a free credit report, your personal credit, and you can check that out. You can get that from the creditreport.com and find that. And that's really important to do as well. Just to make sure not only your credit score, but looking at your credit reports to make sure things are good. Some of that is more personal related than business related, but also very important. So those are the kind of the key things I wanted to cover today. Some helpful materials that you'll get, and we'll start the Q&A in a few minutes. If you got questions, feel free to get them in the Q&A box. So some helpful materials, and you're going to get a copy of this presentation tomorrow. You'll get a PDF of this presentation along with a link to the recording for today's session. And there's some information, these links you'll be able to find. So the cash flow budgeting template that I referenced earlier, there's an Excel file you'll be able to download. I've got links to 2 different state of Connecticut sites. The first one is just a general small business site that's got a lot of good resources. And the second one is the specific one on business taxes that I highly recommend you check out. Also, we go deeper on some of these topics on a video series that we did last year. I believe it was in early May. We did a lunch and learn series on knowing your numbers. And these are the topics that we covered. So a little bit deeper on the financials and managing and budgeting for your cash flow. And then that one on risk management that I mentioned. So you can click on that link. That'll take you to our YouTube page and you can see the lunch and learn series and check these out if you're interested in that. But hopefully you found this helpful. I think this is a time of year where everybody's starting out and they're like, I got the whole year ahead of me. How do I get myself organized? The goal here really is to try to point out some helpful hints for you and some tools to help you plan accordingly and set your goals up for the year using what you learned from 2023 and kind of where your business is today. So with that, Kathleen, I think we will open it up to Q&A.
All right. There are no open questions right now. So if you have questions for Steve that are general in nature or specific to your business, feel free to ask them, especially since about half of you were service-oriented businesses. There may be questions that you have about some of what he showed because he showed things that had more cost of goods sold associated with them. So by all means, feel free to ask it. Colleen says thank you. We appreciate that, Colleen.
Welcome, Colleen. Thank you.
And in the meantime, I did want to ask a question about the cash flow, probably the budget, because the analysis wouldn't matter. But I was thinking about, let's say you recognized, let's start with people who have inventory. Let's say you recognized that you have some inventory that you don't want to sell in the future because it's got lower margins on it, and you've got other products that have higher margins. Would you suggest almost doing a best case, worst case, some kind of scenario analysis for what could I sell this for most likely, or as opposed to just like putting a number out there. Is that better, or is it that the fact that it's an estimate, it probably doesn't matter?
Yeah, I think it's helpful to when you're doing that cash flow budget, that summary sheet that I showed is just kind of a summary sheet. And when I'm working with clients, I often tell them like a couple of these line items, you're going to need a supporting spreadsheet behind it that has some calculations, especially around sales and cost of sales and things like that. Um, and one of the things you could do there is a scenario. You could basically say, all right, if I've got this inventory here and maybe I can sell it for X, what does that give me? And maybe I can sell it for Y, or maybe I can sell half of it for this or half of it for that. That allows you to do some different scenario planning. That's kind of my best advice. And then what you're trying to do when you're doing the budget is, you're never going to have a perfect pinpoint estimate, but I try to explain to people like when you've got a blank sheet of paper, your range of outcomes are this wide. But when you put the numbers on, you can narrow the range to this. And that gives you those guardrails to say, well, if I go down decision path A, I know my financial outcome is over here. If I go down decision route B, it's over here. So it just kind of establishes some guardrails, and it requires a lot of business decision.
Yes. Okay. Burton asks, in the service business, what do you call cost of goods sold?
It's an interesting concept. Service businesses don't really have a cost of goods sold. If you were to look at an income statement of a service business, unless they were selling a product as part of their service. So I'll give you an example. Like if you've got a hair salon, let's say, their revenue is primarily from the people coming in, getting the haircut, color, cut, whatever. Um, they may have cost of goods sold because they sold shampoo. They sold a product, but that's going to be a very small piece of their revenue because their primary revenue is service. So you don't really have cost of goods sold. Now, the cost of your business is really your time. So thinking about that as whether it's a salary you pay yourself or the profit you want to generate to pay yourself through an owner's draw, it's not really a cost of goods sold, but thinking about that as a cost of running your business is your personal salary expense. So hopefully that helps. But service businesses don't generally have a cost of goods sold.
But do they not have a similar concept for certain types of expenses? For example, when we think of what cost of goods sold is, it's something that the more you sell the product, the more that cost goes up. So the cost of the inventory, you're only expensing it at the time that you sell the product. Are there not similar expenses that someone might incur that increase proportionate with their revenue, like
Yes.
certain software costs? Or that might not be a good example, but is there anything similar to that that they would put at the top so that they would still have a gross margin? And what would you call that?
So I would call those variable costs. So variable costs of a business are ones that move up or down with revenue volume. The more you sell, the more you have to spend on those variable costs. So it might not necessarily be a cost of goods sold, but it's good to understand your operating expenses between fixed and variable. And an example might be payroll is an easy one, where if you've got a coffee shop and you're open 4 days a week, you're going to have staff for 4 days a week and revenue for 4 days a week. If you expand to 7 days a week, your revenue is going to go up because you're open 7 days a week, but the variable costs of your staff are also going to go up because you've got to pay people 7 days a week. So those costs aren't necessarily thought of as cost of goods sold on a typical income statement. They're more thought of as variable costs. And as your revenue goes up, they go up. Hopefully, you can increase your revenue at a faster rate than your variable costs. That way, your profit, which would be the difference between the two, your profit gets wider, if that makes sense.
Yes. Burton, hopefully that answers your question. And if not, feel free to ask a follow-up. Okay, Scott says, if I have slow-moving inventory, at what point should I write it off?
It's a good question. I am going to punt this one and recommend you talk to your CPA about this one because this would have tax ramifications. Because if you write that inventory off from a tax standpoint, That means you're going to be deducting it on your tax returns. There may be specific rules around that. Generally, businesses that are audited that have to go through kind of like public company reporting have rules around inventory in terms of how long it's on the shelf or on hand before it becomes deemed obsolete, or they put up an allowance against it in the event that they won't sell it. But a lot of folks on this webinar are probably thinking about this more from a tax standpoint. So I'm sorry, I don't want to give you a clean answer because I'm not aware of what the right answer there would be. So I recommend you talk to your accountant about that one.
And I have a feeling it differs by the type of inventory it is as well, which complicates matters even more.
Mm-hmm.
Okay. Marnie says, I'm just starting out and have expenses of starting up my business, computer, lawyer, professional, conference expenses. Would it be better to report those expenses on my taxes this year or pay myself back through the business as it becomes profitable?
Trying to make sure I understand this question. Um, well, you should report the expenses on your taxes in the year that you paid them. So if you so whenever you pay the expenses, if they're a business expense, they become deductible in the year that you pay them. And that's what you'll want to work with your CPA on. I'm just looking at the question here. We better report these expenses this year or pay myself back to the business as it becomes more profitable. I think it's kind of a tricky one. I think the guidance I would give is when you pay the expenses for the business, that's when you deduct them on your tax return. Paying yourself through the business profits is kind of a different analysis. Doesn't necessarily impact when you deduct the expenses that you paid. Hopefully that helps, Marnie.
The other thing is, I think when you buy a computer, it's not the same as when you pay an attorney
Sure.
or professional conference expenses, because the computer would be amortized over, depreciated over its useful life, which I don't remember what that is, but there are
Yeah.
rules associated with that.
Yeah, they're generally like 3 years. So
Yeah. And the other thing is that I know from the IRS's perspective, when you have startup expenses, you want to put them in the same time period because you have a certain amount of leeway of losses that you can report that they expect to have happen when you're a startup. Whereas if you keep having them, then they look suspicious. They think that you're perhaps really a hobby and not a business. So again, speaking with a CPA is helpful in this scenario because you want to make sure you don't run afoul of any kind of tax rules associated with your business, especially in the beginning, because if they catch you early, they'll keep looking because
correct.
that's how the IRS
Yes.
works. So you
Yeah.
definitely don't want to get in trouble with the IRS early on in the process.
Right. Right. So Kathleen, I was just thinking, I know we may have a couple more questions. Do we want to launch our mentor poll before we
Yes.
forget?
Yep. Let's do that. And you keep asking questions as
Yes.
we launch the poll if you'd like to. But this is to ask you if you have a mentor now that you're working with SCORE, and if you don't, if you would like one. And if you want one, we'll send you an email to tell you exactly how you can get one. And if you don't, it's no big deal. So we'll just launch the poll and leave that open while we keep answering questions. All right, great. MS says, what are places to find an affordable CPA for small businesses? Are subscription websites providing such services worth it?
It's a good question on the subscription websites. I'm not necessarily familiar with those. My advice for folks who are looking for a CPA is to search around for your local geography, and just doing an online search, looking at reviews, looking at user reviews, and looking at the services that they offer. Accounting firms offer different types of services, and you may want to tilt your decision based on the services that they're offering. So, for instance, they offer bookkeeping services. They will offer tax return preparation. They will offer tax planning, estate planning. They may offer. Um, they may also offer even deeper things like auditing services, which a lot of small businesses don't necessarily need. So I would be cognizant of the services that they're offering and what you need help with. Most folks, I recommend go with an accounting firm to do their taxes and tax planning. If you need bookkeeping services, they might be able to do a package deal for you. Some of my clients do that as well because they're not accountants and they don't have accountants working for them, and they would just prefer to have their accountant doing everything, which is fine. Um, and then I would shop around. I would look at the quality of the services, I look at the reviews, and I would look at the price. I would not just look at the price because sometimes you get what you pay for. And this is an area where investing money in an expert who's going to help you is going to save you time and probably money in the long run, because if you try to do some of this stuff yourself, you may miss something. And I always guide my clients to say, I'd rather have you spend your time marketing and selling to your customers than researching the tax code or worrying about trying to do a tax return. So be mindful of anything that's online that is cheap and says they'll do everything perfectly, because it may be too good for to be true. So I lean more towards the local firms that are used to one-on-one interactions with their clients, and I would place the value in the service over anything there.
And Steve, can you talk about how a business owner could save money working with a CPA like that in terms of
Yes.
preparation in advance or things like that?
Yeah. So what, one of the things that you'll want to do is having a good handle on your financial records throughout the year and meeting with your accountant, a couple times a year to talk through your business outlook. They'll help you plan for your estimated tax payments. They're also going to help you think through your tax deductions and any tax strategies that you have. They can help you think through tax deductions for retirement planning, for child college savings plans. They have a lot of different ideas they can help with. I've got a couple clients who just went to a new firm who they each own their own business, and they just went to a new accounting firm, and they've been super helpful and helping them not just save money on their tax return this year, but thinking through tax planning strategies that are multi-year and thinking about life insurance needs and working with, a financial planner. So it's not just, can I deduct this expense or not? They understand the code inside and out, and they've got strategies for business owners to help them save money now, plan for the future, and protect themselves if anything down the road comes up. So there's just a lot more out there than just the, can I deduct this expense on my tax return this year?
And I was thinking too that if you're starting out, and especially if you're not financially oriented, it could be helpful to get off on the right foot by starting with an accountant
Yes.
who could help you figure out how to even keep track of your information in a way that will be helpful to both them and you to make it more effective in the long run when you come back next year for taxes or whatever.
Yeah, and
That
that's
making that investment could be really helpful.
absolutely. And that's the bookkeeping services where you give them access to your QuickBooks, you have access to your QuickBooks, and you connect your financial information into QuickBooks, and they help make sure it's categorized correctly, both for tax return preparation, but also for you to understand where you're spending your money and which categories of revenue you're collecting. So they can definitely help with that as well.
All right. Do we have any more questions? If so, feel free to type them in the chat. We have two people saying thank you.
All right, you're welcome. Right. Any last questions? It's coming up on 1 o'clock. I wonder if we should stop the recording.
All right. We'll
All
stop
right,
the
but
recording.
before we do that, did want to let everybody know that you will receive a link to this recording tomorrow. You can find recordings for all of our webinars on our YouTube channel. If you go to YouTube and search for Greater Hartford SCORE, you can find a bunch of recordings on all sorts of different topics, including finance, marketing, operations, you name it, we've got recordings there. And while you're there, you can subscribe and be notified of future webinars that we add when they get added. So thanks for joining us, and have a good day.